I was born in 1972. The FTSE closed that year at 218 points, having doubled in the previous 5 years. You knew by then that we were in for a rough ride. Economic growth was weak, which resulted in rising unemployment that eventually reached double digits. The easy money policies, which were designed to generate full employment by the early 1970s, also caused high inflation. The market was too high then. It's way too high today. It's always too high if you're looking back. Great investors don't look in the rearview mirror, they look ahead. Even then we had to come, the 73-74 crash. It lasted 2 years and saw dramatic rises in oil prices. We had the miners' strike and the ultimate downfall of the Heath government. Black Monday landed in October 1987, the infamous stock market crash that everybody remembers, and it represented one of the great one-day percentage declines in stock market history. It recovered. The early 90s recession followed, with Iraq invading Kuwait. The market dropped 18% in 3 months. It bounced back. Black Wednesday was next. It came in around 92 and saw the Conservative government forced to withdraw the pound from the European exchange rate mechanism. The market dipped and then it bounced. 97 saw a global stock market crash that was caused by an economic crisis in Asia. It was followed by the one I remember most, because I was an investment advisor at Barclays at the time and I'd invested £20 million of customer savings out of bank deposits and into equity managed growth funds. The dotcom bubble in March 2000 saw that 20 million dive to 14 million, like within weeks. But it recovered. And then September 2001. I was on holiday looking at a TV screen thinking, what on earth is happening? The September the 11th attacks sent a new wave of fear, not just through us all personally, but it caused global stock markets to drop sharply too. But the great companies of our developed world bounced back, and they came back stronger again. Just when you thought we could do with a nice run, bang, the financial crisis of 2007 arrives. But 3 years later, we were back on track doing better again. The market's at 7,500 points today. We can't do anything about these events, but the key thing to remember is that the falls have always been temporary and the rise has always been permanent. Ideally, the best thing to do is to stay in for the long haul, and if you can, contribute along the way through regular pound cost averaging. As any successful investor will tell you, don't look in the rearview mirror. Look to the future and stick in equities because that's what works.